And welcome to this episode of The Bull and the Bear here on moneyandmarkets.com. I'm your host, Matt Clark. Again, glad you're with us as we are each and every time we have a podcast. And today we've got a great topic in mind. I'll get to that here in a second. But first off, I do want to mention that you can check out the Bull and the Bear podcast on Apple Podcasts. We're on Google Podcasts, Spotify, iHeartRadio. Go to YouTube. You can check us out on our YouTube channel. We've got a lot of other videos on there besides just the Bull and the Bear, so you can check that out. Just go to youtube.com and just type in the Bull and the Bear podcast in your search bar, and you should be able to find us with little problem. And leave us a review, leave us a comment, give us a like if you like what you hear. Also, we encourage feedback as well, so you can email us at thebullandbear@moneyandmarkets.com. We'll flash the email address down here, but it's thebullandbear@moneyandmarkets.com. Well, let's get right into it because I think we've got a really hot topic to talk about today, and it's one that has been around for a while. Headline-wise, has been around. It's been at the top of conversations for many weeks now, but the element itself has been around as a trading element for 1,000 years, if not longer. So, and we're talking about gold, and I think it's a good time to bring it up. Right now, the stock market remains in high volatility. Even today on Friday, markets are down. Coronavirus cases are ticking back up. Investors are getting very skittish, and they have the last couple of days. And we're not in a recovery as most people may think. And when that happens, just to boil it down to an elementary level here, when that happens, investors tend to look for things called safe havens. These safe havens are investments that, and you guys can correct me if I'm wrong, but tend to rise when the rest of the stock market is falling. And there are several go-to safe havens. You've got bonds. You've got the dollar. The dollar is also a potential safe haven. But the one that's garnering a lot of the headlines of late, and I know we talk about not paying attention to headlines, but one that is garnering a lot of headlines of late is gold. And gold is a safe haven. It's been around as a trading element for a long time, even through times when I think it was 1933 when President Franklin Roosevelt added provisions to criminalize the possession of gold. Even since then, gold has found a solid footing and has continued to move higher as an investment opportunity for people, and now even more so when you're trying to hedge against potential issues with the market, as we're seeing. Gold is becoming even more and more popular. I think just recently it hit I want to say 8-year high in price, and there's a lot of elements in terms of how to price gold. There's spot gold, there's gold futures, there's bullion. There's a lot of things you can look at, but we're just talking about just gold itself today. And I want to bring in Money Markets contributor Charles Sizemore, as well as Money and Markets chief investment strategist Adam O'Dell. Both are extremely knowledgeable when it comes to gold, and I mean they know what to look for. They know what what it tells, what direction you should go in and how it looks. And I want to bring them in and first off, welcome to the Bull and the Bear again, guys. Appreciate it. And I obviously we're talking about gold and trying to figure out where it's going to go and what it means for investors. So we've seen gold really tick up of late as the market pushes with volatility. So I'll start off with Charles. Charles, give me your take on the gold market at this point.
Sure. Now, it's funny, gold is traditionally an inflation hedge. More than anything else, it's an inflation hedge. But beyond, sort of within that umbrella of inflation hedge, you could also lump in just currency instability hedge. And that's really kind of what we're seeing right now. The data's out there. You see what the Fed is up to. The Fed is printing about $1 trillion a month, and that's trillion with a T. That's a lot of money. That money is getting injected directly into the capital markets. Essentially, they're printing a lot of dollars. Now, I don't think we're likely to see a lot of inflation per se in the next year or two. I think that transmission mechanism of that new currency getting into the real economy is not quite happening the way they want it to. And that's been an ongoing problem for the last 10 years. The Fed's had very loose monetary policy ever since the 2008 meltdown. You could argue they've had loose monetary policy for the last 20 or 30 years. But the fact is, it's obviously stepped up a very big notch right now with everything shut down for coronavirus. So What happens in another year or two, we don't really know, but it looks like the gold market is anticipating inflation, or at the very least, it's just gold is being repriced relative to this massive creation of new dollars. Now, it is one thing to point out. We're not particularly ideological here. This is not some sort of political statement or something. For a lot of times, the gold enthusiast, it almost takes on kind of a political element for them. It's ideological, and they've always made good points for as long as I've been alive. The gold bugs, as they call themselves, and as others call them, the gold bugs have always made good points, but it is somewhat ideological. Whereas, for me right now, I look at this not through some lens of ideology. I just look at the math, and I also just look what the market's telling us. And right now, gold is trending higher, and I think this likely has legs.
And you raise a good point there in terms of looking at things from a tactical perspective rather than just an ideological one. And I know that, as you say, gold bugs, they do look at it as, from an ideological standpoint, they look at it as more of a political statement in terms of their investments. But Adam O'Dell, I'll bring you in now, and I want to talk more about a tactical approach to investing in gold, because I think that's something important that tends to get lost in the shuffle when we talk about investing in gold, the price of gold, and where things can go. So I want to bring Adam O'Dell in and talk to him about that.
Sure. I mean, I think it's first important to kind of acknowledge the ideological gold bug thesis. I mean, the idea that governments control the money printing presses, and that's obviously dangerous is a worthwhile argument. I'm not a staunch gold bug myself. I'm not somebody that is going to be into gold for ideological reasons. But that said, I would never argue against the gold bug thesis. The gold bug thesis is always present, but that just doesn't mean that it's always a good time to buy gold. So governments can print money. They don't do it all the time. Even if they are printing money, that doesn't always translate into inflation. And even if it is translating into some moderate amount of inflation, that doesn't mean that it's on the tops of the minds of investors, meaning that investors aren't always concerned about hyperinflation. So that, from my perspective, buying gold every day of the week, every month of the year, every year of the decade isn't necessarily a good idea. But if you look at the price charts, gold took a massive drop from 2011 onward into 2014 or so. It's just dragged along the bottom in a very consistent basing or bottoming patterns since 2015 for several years. And then it started to trend higher. It's made the characteristic higher highs and higher lows. It's made a bullish breakout of that basing pattern. So I'm looking at the technicals and I'm saying this is a good time to buy gold. I've been bullish gold for a while, and I'm actually bullish gold in a very long-term way. You can also look at the relative momentum. I mean, the coronavirus crash was a great test. Which sectors of the U.S. economy not only survived, but were thriving during that period. I can show you a chart, maybe we can link to it in the show notes, but there was one sector out of about 20 some that actually made positive gains during the worst part of the corona crash, and that was gold mining stocks. So that should tell you something. So you don't have to buy bullion, you don't have to buy gold futures, that can be riskier. But there are a lot of good gold mining stocks that you can get into. Green Zone Fortunes is my newsletter, and we're basically if you sign up for that, we have a report. I have a report where 3 gold mining stocks that I picked out among the batch. Since I started talking about these stocks in early April, they're up 28%, 36%, 56%. The gold mining industry in general is up about in the high 30%, and that's really the best you can get in this type of market. I also wrote a piece kind of in early April because everybody was talking about, gold had 3 up days. President Trump said he got on the phone with Saudi Arabia and Russia and worked it all out. And so people were kind of looking to bottom feed on gold. But since early April, I said, buy gold, don't buy oil. And since then, the most popular oil fund is still down 42% from early April, while these gold stocks are up anywhere from 38 to 40-some%. So I really think that the opportunity in gold is real. It's long-term, and it's not just because of the gold bug argument. It's for the technical reasons as well.
And I think it's important, whenever you look at gold miners, because that, like I said from the top, there's a lot of different ways to invest in gold. You can buy physical gold, you can buy into gold ETFs, you can buy gold miners, and what makes gold miners attractive is how they basically make their money. And what I think it's important to point out here is that, first off, if you're a gold miner, if company X is a gold miner, you have a set cost to bring that ore out of the ground. Let's say that set cost is $500. If the price of gold is $1,500 an ounce, and it costs you $500 an ounce to bring it out of the ground, you're looking at $1,000 profit. But let's say gold drops, and so let's say gold is down to $1,000. Well, you're still looking at that. If you're company X, you're still looking at a $500 an ounce profit, because you have a fixed cost. And this is what makes gold miners so attractive in a strong gold market, because, they're still going to make profit, because they set their costs to where they can, it's kind of like oil. They have a set cost to bring oil out of the ground. And when oil drops to a certain, price per barrel, it doesn't make sense to continue to well it. Gold is kind of the same way, but gold has got a wider margin, so that there are, companies tend to profit even when in downtimes when gold is not necessarily as strong as it is. And this is what makes gold mining, more attractive in terms of an investment prospect for investors. Do I have that right, Adam? Is that kind of the long and short way of explaining why gold miners are a little more attractive when it comes to investing in gold?
You have it right. I would have said it in the opposite order, though. I mean, the fact of the matter is, for the past 5 years, gold prices have been low. So if you look at the gold miners that have survived over the past 5 years, if you look at the gold miners that for the past 5 years have had positive earnings per share, that have maintained their dividends to shareholders, those operations are quality operations, because they figured out operationally how to cut costs low enough so they can survive. I mean, commodity companies are price takers, not price makers. So where technology companies can set whatever price they want for their proprietary softwares, the price of gold is the price of gold. That's what you have to take if you're a miner. So the best miners, the ones that I'm recommending in this report, my top 3 miners, these are companies that have been around for decades. They've gone through high price periods for gold and low price periods, the booms and the busts, basically. And for the past 5 years, they've basically figured out how to be lean, mean machines, and they've survived on a low spot price of gold. So what happens is, when the price of gold starts to tick up from here, the spot price of gold that they can sell their gold for, their costs aren't necessarily rising. In fact, if anything, since energy costs are lower now, their costs are also going lower, because all of the machinery that all runs on fuel. So basically every dollar that goes higher in the spot price of gold is going to go straight to their bottom line and straight to investors in the form of dividends and share buybacks. And it's really a leveraged play on the spot price of gold, because these companies have gotten so lean right now.
And I think that's exactly it. That's exactly what I was trying to say, and you said it perfectly. Now I want to switch gears a little bit, because I know that, Charles, you mentioned, how governments are printing money. I think you said $1 trillion a month with the Federal Reserve, and there's this massive infusion of cash into the market to try to keep things propped up. And I guess I want to know from both of you. I'll start with you, Charles. Where do you see that impacting the gold market?
Yeah, sure. Well, it's basically just simple supply and demand. I mean, when you have a flood of new liquidity being created, it has to go somewhere. It went into the stock market. That's a big reason why stocks are up over 40% from the March lows. It's gone into the bond market. In fact, it goes into the bond market directly. The Fed literally buys bonds, whereas the Fed does not buy gold or stocks. They more benefit from just what I call, and this is not a technical term, the sloshing over effect. You will never find that in a textbook.
The sloshing over effect. I like that. We're going to use that.
It's like, the Fed just dumps so much liquidity in there. Some of it just sloshes out of the pool onto the side. And that's what goes into the stock market and into commodities and what have you. So that's really it. I mean, that's how that affects gold in general. When there is at this point, it's not quite an infinity number of dollars, but getting close to an infinity number of dollars, chasing a finite amount of a commodity like gold. And that actually does come back to one of the gold bug's primary arguments in support of gold, is that, sure, you can mine gold out of the ground. You can increase the supply of gold, but that's a slow and laborious process. And there is a limit to how much gold you can mine. I mean, like every ounce of gold that exists in the world, it's not increasing. It's in the earth. It's been in the earth since the earth was formed, and they're not making more of it, right? We can mine more of it, but the overall supply is finite. And that's essentially the gold bug's biggest argument is, look, you have this tendency and this incentive for central banks to just print money. You can't print gold. Because of that, it should maintain some sort of value. You can make similar arguments for real estate. The difference being that real estate is it's not as portable as gold. Real estate also has the value of real estate may also depend on the economic activity taking place on real estate. And you've seen, REITs, real estate investment trust, have really been beaten up throughout this entire coronavirus incident. So all of that sort of flows back to, why is gold doing well? Again, finite amount of gold being chased by an infinite number of dollars, and people just naturally looking for something that can't be printed.
Now, Adam, I want to ask you, and I want you to look in your crystal ball, and look at your analysis, what it's told you. And I'm going to ask Charles the same question, and then I'll kind of wrap it up from there. But I want to know, where do you see gold in the next 6 months, year, 5 years, 10 years from now? I mean, if you had to, just kind of make an analytical guess of it, which I know that's difficult to say, but if you had to kind of put a figure on it, where would you see gold moving in the near term?
Right. Well, I'm not traditionally a forecaster, but I'll tell you this, it's going to be in the order of hundreds of percentage gains, even thousands of percentage gains. If you look back at some of the last secular bull markets in gold and even silver, I mean, also in my Green Zone Fortunes report, we have a silver report. I mean, silver's trading for about $17 an ounce right now. There's no way it won't go past $100 an ounce in the next several years. And that could be very, very conservative. So, I don't like to put targets out there, but if you look at some of the past secular gold and silver markets, we're talking about thousands of percents of gains. And that's in the spot price of the metal. That's not talking about a leveraged play on a gold or silver miner. So for that, it could be even more. So this is a major opportunity. This is, I don't like to say once in a lifetime, but this is a secular bull market that's just now beginning after a very long bear market in precious metals. So the opportunity is just enormous.
Charles, what are your thoughts?
Yeah, I would agree. If so, the people think this coronavirus incident is sort of one and done, and then it's over, but it's not. You look back to the 2008 meltdown, the Fed never really got out of stimulus mode after that. I mean, over 10 years later, the financial markets were still very dependent on the financial aid stimulus from the Fed. This is not going to be different. This may actually be more extreme. So we are looking at a prolonged period of greater than usual stimulus. That should be a fantastic tailwind for precious metals. I think several 100% gains in gold is probably the base case scenario here.
Yeah, and I agree. I think that we're all three in agreement that we see that. I mean, it's hard to put a dollar figure. You see it a lot. It's sensationalized headlines in terms of gold up to $3,000 an ounce, blah blah. I'm kind of. It's difficult to do that, but I do think there is massive gains to be had in the gold market. And just as a side note, Adam has talked about a couple of reports he's done for his Green Zone Fortunes service, which I highly encourage people to check out. We're going to have a link to how you can get into that in the show notes as well. So make sure you check that out. Guys, the gold market continues to go strong. I mean, there's going to be some ups and downs as it is with everything, but I think we're all in agreement that we see gold moving in an upward trajectory for a while now. Yeah, I mean, I think that's kind of what our thought is the consensus is that gold is going to keep rising. There'll be bumps. There always is, but gold continues to rise. Yeah, I mean, I'm making sure that I'm characterizing everyone's statements correctly. Adam, that's kind of how you see it?
Absolutely, multi-year. I mean, the secular gold market bull market is just starting. So now's the time to get in, but it's going to be long lasting. I'm typically a shorter term or midterm tactical trader. This is one of the longest term opportunities I see available right now. Investment capital goes to where it is treated best. And particularly if stocks remain volatile, and if we do a retest of the lows just by chance, I'm not predicting that we will, but if we do, all that capital is going to flow to where it's being treated best. And I'm almost positive that's going to be gold.
And I think it says something, because I know Adam. I know how he. I like to think I know how he thinks to a degree, and he is. He's very short term, midterm. And when he comes out and he says that this is a long-term opportunity, I think that's something to be taken very seriously when he says something like that. I think that's you should take that, write that down, and hold to that, because that means a lot. Charles, your final thoughts in terms of gold?
Yeah, I would agree. I would call this a high confidence investment right now. I would call we don't have a crystal ball that tells us exactly what's going to happen. But if you're going to say, look, what am I the most confident will be higher 1 year, 3 years, 5, 10 years from now? Gold's at the top of that list. I don't know anything else right now that I would say I have more confidence in being higher 1, 5, or even 10 years from now.
And it also says something. I mean, it's not every day you come out and say, if I feel confident about one thing regarding the market, that this is it and this is why, and I see this being a long-term kind of a thing. So you put all those pieces together, and for an investor, I think the message is fairly clear, and that is that, if you're looking to get in, now is probably the time to do it. And whether you do that, however you choose to do that is up to you. We talked about gold miners. We've kind of skirted the issue of gold ETFs. You can buy physical gold, but you got to pay to store it. There's a lot of different ways to do it. So get educated and make sure you understand what you're getting into before you do so. Another way to get educated is to check out Adam Odell's Green Zone Fortunes, because that's a great place for you to get quickly educated and to have a great understanding of what you should be doing next. And like I said, we'll link to that in our story. So make sure you click on that and check out what Adam has to say. Any parting shots before we head into the weekend? Adam, any parting shots? Any tidbits from you?
Buy gold.
Buy gold. I love it. Charles?
I concur. Buy some gold.
And I agree. So the consensus message from the Bull and the Bear podcast: buy gold. But again, be educated. Check out Adam Odell's Green Zone Fortunes, and that will certainly point you in the right direction. That's going to wrap it up for this episode of the Bull and the Bear podcast. Again, a reminder: you can check us out on Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, various other podcast syndicators we are on. Our YouTube channel, go to YouTube and just do a search for the Bull and the Bear podcast, and you can see this podcast. You can see all of our podcasts. You can also see other videos that we're putting together that include news items, also some educational pieces that we're starting to work on as well. So make sure you check out that. You have a comment, you have a question, something that you'd like to ask Adam or ask Charles or ask myself or have someone address, email us, thebullandbear@moneyandmarkets.com. Again, that's the bullandbear@moneyandmarkets.com. So we'll be on again next week. It is a short week with the 4th of July holiday. Charles and Adam will join me again on Wednesday, where we will impart some more great knowledge for you as an investor, and certainly not steer you wrong, point you in the right direction, and give you the information you need to be a smart, profitable investor. So we will do that for you next Wednesday. We will not have a podcast on Friday, as that is the 4th of July holiday. The markets will be closed, and we will be taking what I think is a very well-deserved day off for the three of us. So for Adam Odell, Charles Sizemore, I am your host, Matt Clark. You've been listening to The Bull and the Bear right here on moneyandmarkets.com.